Business cycles are a type of fluctuation found in the aggregate economic activities of nations that revolves around the stages of expansion, recession, trough, recovery, and peak. In a business cycle, severe and sudden upsets in the economy due to prolonged recession can cause the economic crisis. Among the biggest economic crises that ever existed are the Great Depression, the Latin American debt crisis, the Asian financial crisis, the Great Recession, and the COVID-19 pandemic. Lured by riches, many Americans went wild in the 1920s, investing beyond their needs, often with money they don't have, into the stock markets of Wall Street. This was because people seriously believed that in the 1920s that the stock markets will continue to go up and up forever. But they weren't the only ones. Even banks invested using depositor funds. And when the stock markets crashed in the autumn of 1929, known as the Black Thursday, hundreds of banks lost a lot of money, and when depositors found this, they feared for their own deposits. By 1931, people flocked to banks to take out their money. This resulted in bank runs and the collapse of 4,000 banks by 1933. Because banks have fallen, people saving up all their lives find out that they have no money now, which wiped out many individuals. In addition to unemployment rising to 25%, international trade also collapsed by 65%, and deflation soared above 10% in the United States. However, the depression hits the hardest to those nations that were mostly indebted to the United States, especially Germany, in which by the time Hitler became Chancellor in January 1933, 1 in 3 Germans were unemployed, with the figure hitting 6.1 million, and Great Britain, in which the value of their exports halved, plunging its industrial area into poverty. There are 2 interpretations to how the Great Depression was eventually resolved. The first one was through the election of FDR, who resolved the bank issue through the use of legislation of depositor insurance, as well as creating federal government's programs that help safeguard the economy and prevent another depression. The second interpretation of how the Great Depression was eventually resolved is through the World War II, in which seemingly took care of the 17 million unemployed in 1939. They merely traded off debt for unemployment at the expense of funding World War II. In other words, the war had only postponed the issue of recovery.
During the Latin American debt crisis of the 1980s, a period often referred to as the lost decade, many Latin American countries became unable to service their foreign debt. The Federal Reserve and other international institutions responded to the crisis with a number of actions that ultimately helped alleviate the situation, albeit with some unintended consequences. Indeed, despite a stronger trade shock and a collapse of the international financial system that would last more than 3 decades, the performance of the Latin American economies was better during the Great Depression. The basic reason for that was the management of the debt crisis through a fairly generalized default. In contrast, during the 1980s, Latin America faced strong pressures to avoid default and rather faced a creditors' cartel supported by the US. The lost decade must therefore be seen as the result of the way the US banking crisis was managed, which clearly benefit US banks at the cost of Latin America. Some solutions, particularly the Brady Plan, will arrive relatively late in the process, when the region had in fact overcome the worst of the crisis. It also gave smaller relief than when the external debts were renegotiated in the 1940s and the 1950s. The crisis of the 1980s countered with a more elaborate financial system, but that did not turn out to be advantageous for the region, as it forced Latin America to service its external debt beyond its capacity and forced it into unduly contractionary macroeconomic policies. The main lesson from this is not that financial system is not required, but rather that there is a need to develop an international debt workout mechanism. Furthermore, and most important, it is essential that international financial institutions should never be used to support the interests of the creditor countries.
Asian financial crisis affected most of East Asia and Southeast Asia beginning in July 1987 and rising pace of a worldwide economic disaster due to financial contagion. The Asian financial crisis is a crisis caused by the collapse of the currency exchange rates and hot money bubble. This crisis began in Thailand in July 1987 and quickly spread throughout East and Southeast Asia. The financial crisis heavily damaged currency values, stock market, and other asset prices in many East and Southeast Asian countries. During the late 1980s and early 1990s, Thailand, Singapore, Malaysia, Indonesia, and South Korea achieved massive economic growth and increased their gross domestic product. The achievement was known as the Asian Economic Miracle. They were mainly boosted by export growth and foreign investments. Therefore, high interest rate and fixed currency exchange rate were implemented to attract hot money, which eventually caused the capital market and corporate left exposed to the foreign exchange risk due to the policy. In the mid-1990s, following the recovery of US from recession, the Federal Reserve raised the interest rate against inflation. The higher interest rate attracted hot money to flow into the US market, leading to an appreciation of the US dollar. This situation caused major financial pressure when the foreign investors start to withdraw. The massive capital outflow caused a depreciation pressure on the currencies of the Asian countries. Thailand is the first country to unpeg their currencies and happened to the rest of Asian countries. The countries that were most severely affected by the Asian financial crisis, including Indonesia, Thailand, Malaysia, South Korea, and Philippines, they saw their currency exchange rates, stock markets, and the prices of other assets all plummet. The GDPs of the affected countries even fall by double digits. Besides its economic impact, the Asian financial crisis also resulted in political repercussions caused by resignation both the Prime Minister General of Thailand, Yomdayut, and the President of Indonesia, Suharto.
Moving on, the Great Recession, which is a period of market general decline between 2007 until 2009. This recession happened because of the bursting of the US housing bubble. From 2001, successive decreases in the prime rate had enabled banks to issue mortgage loans at lower interest rates to millions of customers, and the greatly increased demand for new housing, pushing home prices for even higher. However, when internet rates finally began to climb in 2005, the demand for housing decreased, and many banks found themselves in serious trouble as a significant portion of their assets had taken the form of subprime loans, which are kind of losses for them. In 2007, the price bubble of housing burst, and this caused the subprime mortgage market to collapse. Eventually, the demand of the housing sectors plummeted, and the price value of the residential asset decreased. Financial institutions suffered loss as their customers could not pay back their mortgage, hence due to the banks rapidly depleting wealth, banks could not lend their money to credit-worthy borrowers, and even the interbank credit froze. Banks' incapability to extend loans and forced most business to decrease their output level. The decrease in output level has led to higher unemployment rate in America, which is increasing by 6% as compared to the previous year. In true phase from the beginning of the Great Recession in December 2007 to its official end in June 2009, real GDP declined by 4.2% and unemployment increased from 5% to 9.5%, peaking at 10% in October 2009. For the social impact, because of too many interventions, the country's economic trouble was far from over. In 2008, investment banking giant Bastings and financial behemoth Lehman Brothers both collapsed and declared bankruptcy after attributing its financial troubles to investment in subprime mortgage.
The COVID-19 recession is an economic crisis that happened in February 2020 due to the COVID-19 pandemic that affected the world. It can be counted as one of the worst economic crises as it affects most of the economic sectors. So, how does this problem started? The COVID-19 is a pandemic that started in Wuhan, China in 2019 and has spread globally due to the economic activities around the world. Thus, many countries decide to control the pandemic with doing the lockdown, which made people movement resisted as they can't go outside without essential reason. In addition, the lockdown that declared by government had led to another problem, which is panic buying. This problem happened due to many people that need to buy groceries, face masks, and hand sanitizer as the preparation for the lockdown. Other than that, important events such as religious, sport, and cultural events need to be postponed or cancelled due to the worsened condition of COVID-19 pandemic. As example, the cancellation of Olympic 2020 that should be held in Japan. Many economic sectors and activities need to be stopped due to the declaration to work at home from the government. This clearly affects economic sectors, especially the business that need to provide face-to-face services. For example, retail store and restaurant. Moreover, one of the business sector that critically affected by the pandemic is travelling and tourism. This is because travelling and tourism activities need to be stopped as the case will increase if the sector is not closed. As example, we can see that many airlines that need to be closed during the pandemic and many airline employees lose their job. Surely, COVID-19 recession had led to several outcomes that affect the economy around the world. At first, the problem that happened during the COVID-19 recession is 2020 stock market crash. Other than that, the other economic crises that happen as the outcome of COVID-19 recession are the rise of unemployment, the collapse of oil price, and the increase of government debt.